The Reserve Bank of Australia is expected to finally cut rates this week. However, the Aussie dollar is firmer this morning and may rise more as global markets take some of the Trump tariff premium out of the US dollar. And there's good news for New Zealand's economy, with a manufacturing expansion in January. That's coming up in our 5 Things in 5 Minutes on Monday, February the 17th. And then in today's bonus deep dive interview, ANZ Australia Senior Economist Adelaide Timbrell explains why ANZ Research has increased its growth forecast for this year to 2.4% from 2.2%.
The labour market in general has been a real bright spot over the last couple of years, and we think that's going to continue.
But first, in 5 and 5 with ANZ, the big event to watch this week is the Reserve Bank of Australia's rates decision tomorrow afternoon, where it's expected to finally start cutting rates, with a 25 basis point cut in the cash rate to 4.1% almost universally expected, including by ANZ's Group Chief Economist, Richard Yetzinger.
Finally, the RBA joining the ranks of easing central banks. Look, I can't see them not going, even though there's some debate. They have plenty of support for the idea that they can afford to cut interest rates once and then wait and see how things evolve.
It must be the most long-awaited, most locked-in rate cut that's been there for some time.
Well, you would think so, but then when we had the inflation number, which opens the door for the bank to go, lots of people said, oh, maybe they can't go now. So I think people are very invested in this idea, it seems to me, that the RBA is on hold forever. But of course, nothing's forever. The Reserve Bank of Australia has an inflation target. Inflation is in the band. And sure, there are factors which mean inflation is not dead and buried, but it doesn't have to be dead and buried just to deliver 125-point rate cut from the highest interest rate levels in about 15 years.
As of 4 a.m. Sydney Melbourne time, the US dollar index was down 0.6% from Friday morning. The Aussie dollar was up 0.9% at 63.50 US cents, while the Kiwi was also up 0.9% at 57.29 US cents. Number 2. That US dollar weakness seen over the weekend is a theme to watch and may overtake the global focus on US interest rates, according to Richard.
Even at the moment, when you start discussing tariffs with people, it inevitably turns to a discussion about the Fed and bond yields. But actually, the US dollar might be the big financial market mover out of all of this. The dollar has, you would think, a pretty decent tariff premium in it. In real terms, on the Fed's trade-weighted index, in real terms, it's trading at the highest level since 1985. But the dollar hasn't been able to keep appreciating, even though Trump has announced lots of tariffs. Admittedly, they've been kind of a bit push-me-pull-you, a bit of an announcement and then a deal or a delay or something else. Not all of them, but certainly that's been the trend. But the dollar hasn't been able to benefit, and in fact, it's started to weaken. And if you look at some of the particularly cyclical currencies like Aussie and Kiwi, they've just been trading a bit stronger. This could be a year where we get a pretty significant turn in the US dollar cycle.
Number 3. ANZ's head of FX research, Marja Ben-Zaman, will also be watching the Reserve Bank of Australia closely tomorrow afternoon with a view to how it might affect the Aussie dollar.
This rate cut has been very much well priced into the market. So again, it also depends on whether we get a hawkish cut or a bit more of a cautious cut. It's really going to drive the direction. But we think that there might be a little bit of an upside risk just because a lot of this has been priced in ahead of the meeting. And I mean, when we look at the Australian impulse, broadly, Australian data impulse has been really strong. Household consumption holding up, tight labor market. So that really points to the fact that a shallow RBA easing cycle will play out as we expect. Only 2 rate cuts this year. Then markets are expecting many more. I think they're expecting about 3 cuts at this stage for this year.
Number 4. Marja Ben is also keeping a close eye on the euro, with a view to longer-term weakness and the potential for it to hit parity versus the US dollar at 1-to-1 with the US dollar, down from €1 buying $1.04, 0.91 at the moment, even though a possible peace deal in Ukraine gave it a boost late last week.
So optimism around euro gains is likely to fade quickly if these talks don't go through. Now, even if that, let's say there is a resolution between the Russia-Ukraine war and there's some positive developments there, I don't think they make up for the ongoing weakness in the euro area, and the fact that the ECB needs to consider further easing, which we expect to play out through the course of this year. So broadly, this ties in with our view that we expect further downside in the euro over the next 2 quarters and probably will likely see it touch parity.
Number 5. There was some good news from the New Zealand economy on Friday, with the Business NZ, BNZ Performance of Manufacturing Index showing an expansion in January, the first expansion in 23 months. Here's ANZ New Zealand economist Henry Russell.
It still remains below its long-run average, but nonetheless, with all the subcomponents also now back in expansionary territory, it does bode well for the outlook moving forward and suggests that the manufacturing sector is responding to lower interest rates, and the PMI has been one of the indicators that has been lagging the recovery and other high-frequency indicators we've seen. So today's data is certainly reassuring on that front and reinforces our view that a recovery is underway in the New Zealand economy.
Henry Russell there. Now, in today's deep dive interview, ANZ Australia Senior Economist Adelaide Timbrell tells my colleague Alex Tarrant why ANZ Research has increased its growth forecast for this year to 2.4% from 2.2%.
What it represents is a real acceleration compared to 2024. And another bright spot within the 2025 outlook, which is also connected to this stronger GDP growth, is that there is going to be less inflation in 2025 than we previously expected. And we're also expecting to see a little bit less unemployment than previous, which of course helps with more people spending and is a sign, although not a cause, that businesses are doing okay as well.
And so just looking within the breakdown of that GDP forecast, where do you expect to see the sort of private versus public demand sitting?
We're still expecting to see public demand outpacing private demand. And this is something that in Australia has been going on over the last 10 plus years. Government spending has been moving faster than what we see in the private sector, particularly at the moment with a big build on in Australia, a lot of infrastructure investment, but also due to other programs, including health spending, things like that. So we don't expect that shift to change in the near term. However, when we look out a little further in our forecast of 2026, we do start to see a convergence between public and private demand, where public demand is slowing a little bit and private demand is speeding up.
And just that catalyst for private demand speeding up, is that related mainly to dwelling investment, or what other factors are there?
So household consumption has surprised upwards in Q4 of 2024. We saw retail sales coming out at 1% growth quarter on quarter and an increase in per capita retail volumes for the first time since 2022. So not only is the average person spending more, they're actually buying a higher volume of retail goods. This is a great sign for the health of the consumer. Tax cuts from 2024 onwards, as well as the expected rate cuts in 2025 in February and August, are going to give a little bit of a boost to the consumer as well. When households are spending more money, that allows businesses to get more money, which is a really great outcome for the business sector and should lead to a little bit more business investment. We're also seeing a little bit of an uptick in dwelling investment compared to our previous forecast. We do expect to see more activity there than we previously had expected, and that really comes down to prices. There just hasn't been the same uplift in the cost of a new dwelling in the latest CPI data, and that should be a good signal of less capacity constraints in the sector, which means there's more ability for activity to take place.
And I guess that business activity allows for hiring and the public demand allows for hiring. So where do you see the unemployment rate heading over the next year or so?
When we look at how economic activity is evolving, but also how leading indicators of the labour market have printed, we're seeing less upside risk for the unemployment rate. So we did previously have the peak quarterly average unemployment rate at 4.3. We now have that peak at 4.2. So over the last 10 months in the monthly data, the unemployment rate has been printing really in a tight range. It's been between 3.9 and 4.2 10 months in a row. So when we look out further, we're not really expecting to see much above that in the monthly data. So an average of 4.2 being the peak, and then we'll see that drift down to under 4% over the forecast horizon. Now that comes down to the fact that there's still this big build going on. So public sector jobs have a lot of potential so far. We've seen a lot of healthcare jobs, which come from, the aging population and population growth in general. But we've also seen a rotation to market sector jobs. So there has been a little acceleration in private sector employment growth too. All of these things really help with keeping the unemployment rate low, demand in the economy supported by that stronger household consumption, continuation of public demand, all feeds into a very resilient labour market. And I think the labour market in general has been a real bright spot over the last couple of years, and we think that's going to continue.
Adelaide Timbrell there, speaking to my colleague Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, February the 17th. Catch you tomorrow morning with more from Adelaide on Australia's economy on the eve of the RBA's decision tomorrow afternoon. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.